Joining us right now is Jeffrey Lacker. He is the former Richmond Fed president and currently senior affiliated scholar at George Mason University. And Jeff, thank you very much for being here. Probably not going to be something that changes anything for today, but it could have a big impact on when we can expect to see a rate cut. What do you anticipate first from the CPI, and then what do you think the impact will be in terms of when we could get a rate cut?
Best guess for the CPI is the core is going to continue about the rate it's been, north of 3% at an annualized rate. I think that's consistent with the figures you showed earlier today. Headline down just because gasoline prices have come down. But for the broader question about the Fed policy stance, I think there's a case could be made that they're not as restrictive as they thought. I think that's the broad theme of why they've been pulling back on expected rate cuts this year. I don't expect any rate cuts this year, frankly.
We had Ian Shepherdson on with us earlier this morning, and he made a compelling case to say, look, if you wait until inflation gets back into a level where the Fed feels comfortable with things, it's going to be a problem, that things are slowing down already in areas not just like credit with some of the banks, real estate, and other places that you're going to see problems kind of crumbing up. He made the point that for small businesses trying to borrow at 9% interest rates really is going to have a crushing impact on hiring, and that will affect unemployment. His point is you need to cut now before things get too far out there. What would you say back to that?
So the economy's been exceptionally strong over the last couple of years. Growth has been strong. Labor market's been very tight. I think that's a sign that we're above maximum employment, the way the Fed is sort of chartered to think about these things. And to the extent that that's not sustainable at a 2% inflation rate, I think that's some of the sacrifice you got to make to get to 2%. I don't see a plausible risk of the economy falling off a cliff into a recession anytime soon. That could emerge, but it's not on the horizon right now if you look at the indicators. So, yeah, some sectors are going to be up. Some sectors are going to be down over the near term. That's a sideline compared to getting inflation to 2% on a sustainable basis.
In other words, this is the type of pain that you need to see and the Fed actually expects to see before it can actually lower rates?
Certainly, yeah. I would think.
In the room today, my guess is even if this was a very hot or a very cold number, it's not going to change what happens today.
No, I don't think so. I think, all eyes are on the dot plot, I think, for today, for better or for worse, the way they've designed it. I think that they're wrestling with how restrictive policy is. I noticed you had Steve Leisman on your show, excellent correspondent and analyst, and making the case that policy was pretty restrictive. I beg to differ. I think that if you look at the 5.3% funds rate, compare it to trailing 12-month core PCE inflation, their favorite indicator, it's just 2.5% real rate. If you compare it to the year-to-date core PCE number of 4.1% inflation, well, then it's at a real rate of 1.2, which is not very restrictive at all. And those figures happen to bracket the current estimates of R-star, the long-run neutral real interest rate, from the two standard models the Federal Reserve System uses. One, the New York one, Laubach-Williams, 1.2%. And then the one in the Richmond Fed gets less attention, deserves more, Lubick-Mathis of 2.5%. So those are right in the ballpark. I'm going to be looking in particular at the right-hand column on the dot plot that shows their estimates of the longer run federal funds rate. That inched up a tad. And in fact, if you look at the dots, 8 people moved their dots up, revising upward their estimate of the neutral rate. I expect that to continue at this meeting, and reflecting their sense that, yeah, policy in December wasn't as restrictive as they thought.
Yeah, and I guess your point is we're not going to see a cut until next year at some point. If we get a hotter than expected CPI number today, does that absolutely mean we won't see rate cuts this year because you have to see months in a row before
I
the thing
think
can be?
I just think they're off the table this year, period. They had 6 really good inflation reports at the second half of last year. Then they had 4 bad reports. What will it take to convince people that, yes, that 4 bad reports isn't going to happen again after another 6 good reports? Well, it's going to take at least 6 reports that are good, and it's going to take a few more too, and that takes you into next year. 6 reports takes you to December. So I just don't think they're going to be as confident as they want to be, because you have to remember the Fed's really averse to whipsawing the market, to cutting and then like within 12 or 18 months having to raise rates again. And I think, the case that they might have to raise rates in 2025 is a serious one, ought to be on the table. And I think they got to be prepared for that as well.